Tier 5, selecting the optimal strategy. Cluster 1, how to trade long calls. This is trading at the money calls. Before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. You can get a copy of that by calling 1-888-OPTIONS. That's the home of the Options Clearing Corporation. Today we'll be discussing long at the money calls specifically. Trading at the money calls is different than trading in the money or out of the money calls. Each market scenario demands a different strategy. And here we'll be discussing market scenarios that are appropriate for specifically at the money calls. In at the money calls is a call where the stock price is about the same as the strike price. They're cheaper than in the money calls, but they're more expensive than out of the money calls. At the money calls are made up of time value. They may have a small amount of intrinsic value. That's because the stock price doesn't have to be exactly the same as the strike price. It just has to be close to be considered at the money. Therefore, the option could be technically slightly in the money or slightly out of the money. And so therefore there may be some small amount of intrinsic value. The delta for at the money calls is about 50. They're made up of mostly time value, and the time value of at the monies is greater than it is for out of the monies, and it is greater than it is for in the monies. Therefore, the time decay is highest for at the money calls as well. That is, as each day passes, at the money calls are punished more than any other. So these options are considered a leveraged directional play. Let's compare in, at, and out of the money long calls. As you can see, the premium for at the money calls is kind of somewhere in the middle between out of the money calls, who have the lowest premiums, and in the money calls that have the highest premiums. Because the premiums for at the money calls are between in the monies and out of the monies, their nominal risk is between the two as well. Whatever you pay for an option is the most you can lose. So we can lose less than we can with an in the money, and we can lose more than we can with an out of the money. Because of the characteristics of an at the money call, it's appropriate for a minor breakout or a pretty good move to the upside. We're not looking for a steady increase like we are with an in the money call. We're looking for something a little healthier. Maybe a breakout off a flag pattern like we see here, where there's an upwardly thrusting flagpole on heavy volume, and then some inside small candles on low volume, and we're expecting a breakout like this green candle here. That could be very appropriate for an at the money call trade. We're looking for a directional breakout, but not really profound. Just a pretty good move is how I'd best describe it. Now, this is not an investing-oriented strategy. This is a trader-oriented strategy. It's appropriate for active traders. You will hold an at the money call trade for a day to maybe 5 days. It's short term, so it's appropriate for active traders. A chart like this might have been a good at the money call candidate. If maybe a week ago, when the stock first closed above the 50-day moving average, which is represented by the red line, and we were looking for a breakout up and above that, which we got over the last 3 or 4 trading days, if we were looking for that sort of a breakout to the upside, an at the money call would have been an ideal way to play that type of trade. We'd risk less than we would with an in the money call, but we would be able to get a little bit greater leverage by doing it this way. And I'll explain why in a second. At the money calls, as you can see here with Coca-Cola, with the stock at 68.31, the stock price is smack dab between 67.5 strike and the 70 strike. So the at the money calls are these, the 67.5s and 70s. They're the closest strikes to the current stock price. So the benefits of using an at the money call for a minor breakout is that they're highly leveraged. They're cheap compared to the stock. And they've got that 50 delta, which means they move about 50% as much as the stock. So if we pay, say, 5% of what the stock price is, well, we get 50% as much participation in the price action. That's called leverage. If we could buy 2, 3, 4, 5 of these calls and spend way less than we can buying the stock, but get much more participation in profits if the stock goes our way. Now, leverage, of course, is also the detriment to this trade, because if the stock doesn't go our way, we can suffer greatly as well because of leverage. And the stock doesn't necessarily have to fall in order for this trade to be a losing trade. Because of the high rate of time decay, or also called theta. Theta is the daily incremental loss through time decay. Because of that high rate of time decay, even if the stock doesn't move, our long at the money call can become a loser. So that's why I say this is a short-term play where we're looking to capitalize on leverage and we're looking for a pretty good move in the underlying stock. We need the move to happen quickly so we don't suffer too much time decay, and we need to make the move big enough in our direction in order to take full advantage of the leverage feature of these at-the-money calls. This has been a presentation of Market Taker Mentoring, LLC.